get cold. Me too, I'm freezing. Bring us some, I like that one. I like that. Okay.
Actually, he's already got sweaters.
He's got a, no, he's got like a, man. Oof. Okay, I'm gonna do a quick cursory, I think. Okay, if we could like have eyes up here. You're gonna join us today or no?
Yeah,
you're like, yeah, I'm out of here. If we could put electronics away, please, it would be helpful. It would be helpful. Let me just go through people that I haven't seen yet, just to make sure they're not here. Monica Cruz.
She just said she will be like 5 minutes.
Is she here?
Oh, yeah, she's 5 minutes late, but she's, yeah.
Is she here?
I know.
Monica Cruz is not here. No, she doesn't. I'm not trying to pick on you. I'm just, you know how I'm an accountant. Reina. Reina. No Reina. Okay. Noah. Noah.
No.
So I was on a plane the other day and I saw this movie, which some of you may have seen, called Ferris Bueller's Day Off.
Yeah.
And it's like Carnegie. Thompson, it's kind of like a high school, whatever. Chelsea, Brandon Noodleman, Emmanuel, Rebecca, Janae, Chantel. Okay. Hey, welcome. Your name's Chantel?
No, I just wanted you to know that I'm here because they're calling me in.
You didn't hear what I said. I said, if I haven't seen you, I want to call your name, Jason. If I didn't. So I got you guys. I'm on it. I'm on it. I was here watching you take tests.
We're testing you.
So anyway, so welcome. This is the fourth session of RE 5890, Real Estate Accounting. Kyle, are we on?
We are.
We're on. Okay, fantastic. Listen, so we've had a couple of remote sessions. We're back live. Welcome. Whoever's not here, we miss you. Wish you were here. It'd be a lot of fun. We're going to move on. We're rolling forward. We've covered several topics related to real estate accounting. We've talked about leases, for example. We've done an accounting primer. We've done some case studies helping us with some financial analysis. We've taken a look at a home builder. We've taken a look at some REITs and some supplemental information and taken a look at some of the financial and operational data that they put. We're going to move on now to development activities. And we're going to go into greater detail today. So we'll deal with development activities and accounting for development costs today. We'll likely in the next session move on to accounting for sales, okay? We're also going to continue with our case studies as time goes on, all right? We're going to look at, when we look at development costs, we're going to take a look at what we call pre-acquisition, and we're going to talk about post-acquisition. We're going to talk about, direct and indirect and marketing costs, etc., okay? We're going to figure out how we allocate the costs. We're going to talk a little bit about job costing and project accounting, and we'll talk a little bit about, we've got some experts in it, construction billings, retention, loan draws, etc. And you'll all become very familiar with all of these topics as the balance of the term goes on. But we start with accounting for development costs today. We're also going to go through some current events, okay? I'll bring you some insight on, some of you have asked what's going on with Brexit. I'll give you what I've read, what I've heard. I'll give you a little bit of some insight on what I saw in real estate where I was. And we're going to go over the case study. And maybe we'll finish class early today.
That'd be nice.
It's never happened. So I don't know. It's never happened. Ben, you had a question?
I was just wondering how people did on the case studies relative to the previous case studies.
Well, not well, but we'll talk about that.
Sure
I'd rather talk about that when we talk about case studies so that we can start off on a good note. So I was on a plane, I had nothing else to do for 10 hours, right? And I got the great case studies. Oh, you don't know, huh? Drink. I drank and then I graded the case studies. How was that? How was that? How was that? So, anyway, okay, so. Someone asked me, I forget who it was. I don't know if it was Grumpy. Was it you? I'm sorry. Is that Grumpy or Quincy? What's that? Grumpy. Someone asked me. So the first question that I asked today is, where are 10-year treasuries?
1.45. I think it's about 1.39. 1.456.
It's like 1.446 something or other. Where were they when I left 5 weeks ago?
1.7 or something?
Like 1.8, right? So we've had 40 basis point reduction, right? What's that on a, we don't need to check, Claudius. We don't need to check. It's 1.446. Trust me, I read the journal this morning. But, you know, roughly we've lost, percentage-wise a significant amount. I mean, is that good? Is that bad? What happens, we've talked, some of you, a lot of you have taken a capital markets class. What's happening to the yield curve? If long-term rates are coming down, what's happening to the yield curve? It's flattening, right? They were already like at zero here, right? And so they were like kind of like up here, now they're kind of like here, right? I mean, and what happens, what's indicative of a flat yield curve? If you remember, do we remember what?
Recession.
Well, we didn't say recession, but uncertainty, right? Because again, if people are not willing to put money to work longer term, what's that saying? We don't know what's happening in the future. We're kind of concerned, right? And I think I showed you a chart where I think, if you go back over the last 40, 50 years, invariably every time that the yield curve flattens, there's sort of economic upheaval, okay? Now, it's never the end of the world. Someone who's not here today sent me this long missive the other day talking about Brexit, and we'll talk about Brexit. And the whole thing was, is it the end of the world? Is this like Lehman Brothers? Is it, what's going on? And listen, I don't think we can ever, be concerned long term. So we may need to reposition the activities that we undertake. We need to be aware we cannot sort of sidetracking a little bit. I had a meeting with somebody the other day, and he's a big developer, and his comment was, real estate is very subject to macroeconomic conditions, and so we can't ever forget what's happening macroeconomically, and we cannot necessarily overcome what's happening macroeconomically, all right? But we can react to it, right? We can reposition. I had a boss that would always say, when we can develop, we develop. When the markets don't allow us to develop, then we reposition, we restructure, we help banks with restructuring. We do whatever we can in good times and in bad. And so we need to understand what's happening now. If in the United States, 10-year treasuries are at 1.44, 45, whatever %, what are they in other parts of the world? Do we know? Do we know? Capital markets are worldwide, right?
They're less.
They're less. How much less? Give me an example. Give me where is it in Germany today? Where did it go into Germany over the last 3 weeks? Where did the Bund go?
It's a lot lower, isn't
Is it negative or?
Less than zero. Less than zero. Where are they in Japan?
Negative, like a point or something?
I don't know, I think if you read the journal this morning, it's like minus 0.2%. Where did I put it? It's right here. Minus 0.256. Where's the UK? UK's in all Brexit, right? Everybody hates the pound. Nobody loves England, right? Where's the 10-year English Treasury? More? Less?
it? It would have to be less.
It would have to be. Why would it have to be?
Well, because of the kicking from Brexit.
Well, but wouldn't you think it would be more? I mean, how do you attract capital into your country? You've got to pay higher interest rates, right? Don't you have to compensate people? Well, that's what logic would tell me, but 0.85% and so on, right? So, the first question that I sort of had, what happens what happens in economies where interest rates go. So what is the implication of a negative interest rate on a security, for example? So we buy a bond that yields negative 0.25%. What does that mean?
You get back less.
So you give $1 and you get back whatever, 90, whatever cents, right? And so people are willing to accept, people are willing to pay in order to not lose a significant component of their capital, right? I mean, that's a frightening thought, because when we invest money, what do we want to see? We want to see some sort of capital return, right? Capital appreciation, right? And here it's negative. Now, we'll talk about Brexit in a second. The question that I asked in Europe the other day was, if in fact there is a relationship between 10-year government bonds, right, sovereign bonds, presumably AAA or AA or very highly rated securities, right, and real estate, right, if there is a relationship, and what should the relationship be? Do we have any sense of what sort of spread we should have between risk-free securities long-term and real estate returns? Any idea?
2-3%.
What do historical trends tell us? So if Claudius, if that's 2% plus 2% means I should be willing to buy an asset for 3.44 cap rate, or on the higher side of that, 4.44% cap rate, is that where we are today? A little bit higher. I think you're close. I would, again, there have been times where we've seen this. If you go back to 2007, 2008, we saw with very high class assets that we had a 1 to 2% or 100 to 200 basis point spread between treasuries and cap rates for prime assets, okay, for Class A assets. I think historically, if we were to say 3 to 4%, that's probably a more realistic indication. And I think from what we last saw in this country, that's probably about where we are today. So interest rates have come down, cap rates have continued to come down, but they've maintained a relationship between, the government bond and what people are willing to assume as a return on real estate. Now the question I ask is, if all of a sudden this goes to a minus, 0.2%, where are cap rates in Japan? I don't know, I wasn't in Japan, I was in Europe. So where are cap rates in Europe today? Where do you think cap rates are? And why do I care? Other than to make conversation now, why do I care? I care because if interest rates continue to drop in this country, what's going to happen? Right? I mean, are people...
It's going to affect the whole world.
Yeah, and what's happened is actually you're starting to see cap rates, 2 to 3% on prime assets in major markets and major asset classes in Europe, which would lead me to believe that in this country, if we continue to see this dropping, that we're also going to then get back down into that sort of now. Yes, Quincy?
How is that sustainable?
Well, that's the question that I ask, right? Because the question is, so what is the all-time low yield on a 10-year treasury? Fun facts to know if you read the Wall Street Journal. What's the Wall Street Journal say this morning? Chelsea, did you read it this morning while you're having your coffee? No, you're just having your coffee now. What's it say? Naughty girl? Is that what that says? Okay. I'm sorry, I didn't. Historic low, 1.385%, or 1.37, and it got down to this last Friday, but 1.37%. So we really are at historic lows. Now, Quincy, I think your question is, if you buy something at a 2 or 3% cap rate, or even if you buy something at a 3 or 4% cap rate, right? All of a sudden treasuries go up to 3%, right? And we maintain the same relationship that we have with 300 to 400 basis points, and all of a sudden cap rates go to 6 to 7%, right? We've got an inverse relationship between cap rates and prices. What do you think happens to your return if you buy at 3 or 4 and sell at 6 or 7? You may lose a ton of money, right? And so, yeah. Quincy, I don't know whether that's sustainable or not, right? The question I ask is why would people even buy this? But they're buying it. Why would people buy this? You know, the less than 1%. I don't know, but people are doing it. I mean, that's where significant sums of money are. I didn't save it, but there was something I was reading the other day in like Financial Times or something. It was like 20 or 30% of invested currencies and in government bonds throughout the world yield negative rates today. So I'm not talking about 10-year, I'm talking overall. So a lot of the short-term maturities, shorter-term maturities throughout the world are yielding negative rates. So 30 or 40% of invested dollars are invested at negative rates today throughout the world. I mean, that's kind of frightening in a way, right? If you stop to think, if you were to extrapolate that to the U.S., right? How much just U.S. debt do we have in this country?
19 trillion.
19, 20 trillion, something like that. So, you know, stop to think that we could potentially have, what, $6, $7 trillion invested if we were to extrapolate that at negative rates. We're talking about significant sums of money at the end of the day. So, you know, I think there's, I don't know, there's uncertainty out there. At the end of the day, there's uncertainty. People are not willing to put money to work at long term. There should be an implication for real estate if real estate is a long life asset, right? There should be uncertainty as well, right? And to your point, I think the question, how long has Japan been in this sort of stagnated environment? Like how long, how many decades? I mean, Japan for 20 years has been in this sort of stagnant economy where there's no growth, right? And the big concern here, obviously, is asset deflation, right? At the end of the day, that, you know, there's no inflation, right? Asset values don't increase, but they decrease, all right? And that's a concern. Did you have a question, Quincy?
I was scratching.
Sorry?
I was scratching with it.
Oh, okay, all right. That's just, all right. So anyway, so that's where I'd start with treasuries. I'd kind of say, hey, listen, I don't know what's going on. You know, Italy. I mean, Italy's like got like no sort of fiscal responsibility at all. 1.2. It's kind of interesting. So anyway, now I'm curious. We'll talk about Brexit in a second if you're interested. There's a movement in Italy called Cinque Stelle, which in fact the new mayor of Rome belongs to that party. They're sort of anti-EU as well, so they want to leave the EU. So what is Brexit? So you guys, I haven't read any U.S. papers. What's Brexit? What does it mean anything to us? Should we be concerned? Should we care? Yes. Okay. Go.
Well,
You talk now.
well, because we rely on LIBOR for a lot of our transactions, and that's right out of London.
Okay. LIBOR is what?
London interbank
Offered
something rate.
Offered rate.
Offered rate.
Offered rate. Okay. So that's sort of the equivalent to what in this country?
10-year treasury.
Well, no, it's kind of equivalent to what our Fed funds rate would be, right? So in theory, so it's become much more than that, but in theory, historically, that's the rate at which banks would loan to one another, okay? And so, because it's a wholesale rate, it tends to be lower. But what I would tell you, and I don't want to, I think this is all important, but what I would say is, I don't really care about LIBOR, because at the end of the day, and I say I don't care about LIBOR, it doesn't matter what the index is, right? So, you know, you've got in Europe, most transactions now are based on Euribor, which is a, you know, European interbank offered rate, okay? And in this country, for many years before we used LIBOR, what did we used to use? Prime. Does that ring a bell to anybody?
Yes.
Prime. So, I mean, you can create a benchmark that you want and then, you know, have a spread from it, okay? So, so the fact that we use LIBOR, if we don't use it tomorrow, doesn't matter, okay?
But don't we base our adjustable rate mortgages on LIBOR?
No, I mean, we could, but we don't have. I mean, we could do it on HIBOR, as I say, right? Hialeah interbank offered rate. We we can base it on anything. I mean, it doesn't really. So, but I'm sorry. So, but the point is, we could, but we could change it to something else tomorrow, right? So, I mean, we could go back to using prime. If you go to the Wall Street Journal every day, there is still a prime rate that's sort of published by all the major banks in this country. Most people don't use it. Okay, so if we don't use LIBOR, we could use something else. The fact that LIBOR is important, right? So why did LIBOR gain all its, and I don't want to repeat what we talk about in capital markets class, but why is the L in LIBOR so important? It's because I don't draw the world very well, right? So have you guys ever seen a world map from like Japan? Like if you see a US world map, you look at a world map, you can't draw, okay? So I'm going to try my best, okay? Kind of like, okay, this is Florida, right? Okay, Central America, right? South America, okay, right. I mean, I know it's, hold on, Cuba's really big, right? No, I'm just kidding. So, the Caribbean, all the little islands, right? And then you see Europe over here, right? Like England, right? And, how the heck do you draw Europe? Kind of like, I don't know, whatever. And then Africa's kind of like here, right? And it sort of merges into sort of Asia, and India's over here, whatever, right? And Japan's over here, right? So, and China's over here somewhere, whatever, okay? So, if you look at a world map, it's always kind of like that, right? This is the middle of it, right? If you go to Japan, it goes from here that way, because they're the center of the universe, sort of in their perspective, okay? And I never really, realized that till I saw a Japanese map, right? But the reason it's important is one of the reasons that London is important is because in London you open markets as Japan closes, and you close markets as the West Coast opens. And so it's the one place in the world, the financial world, where you can cover the world, from one place, okay? Geographically, it also is very easy to go everywhere, okay? And so there's a whole bunch of other reasons why London became the financial center of the world. But what's happening now is that, and I don't want to jump, is one of the threats that Europe is making out of the UK is saying, hey, look, we're gonna take away all the financial, transactions, all the clearing that the EU does. We're gonna take all of the sort of EU facilities and organizations that we have in London and take them away. But so London is important not only because of the benchmark rate, but because it is the financial center or the financial hub or capital of the world, regardless of what New York says. Okay, so the UK is important now. So I ask the question again: is it important that the UK? Yes, Ben.
Oh no, I was going to answer your question with my thought.
Oh, tell me.
I mean, we don't know. I mean, people are, reacting now to, look, Britain or London, whatever it is, UK's exit, but it's because we don't know. I mean, maybe from their perspective, being part of this union is weighing them down for whatever reasons, or, maybe they're not getting their fair share, and that's why they decided to pull out.
So, I mean, there's a whole bunch of different things we can talk about there from that perspective. I don't know, the answer to your question, or to validate what you're saying is, I also don't know. Good afternoon, Ms. Steinhaus. How are you?
Good.
You awake today? Okay. We don't really know what's going to happen, but there's a lot of reasons. So I focused on London as a financial center, but so how many people live in the UK? Do we know?
About 60 million?
Yeah, I seem to recall 80, but we could say 60 to 80. It's a lot. It's a lot of millions of people. Okay, and from an economic perspective, how big an economy is it in the world? Do we know? We know it's part of the G7, right? So it's got to be one of the top 7, right?
Top
So
3?
Probably, yeah, it's probably like, well, U.S., China, Japan, France, Germany. So it's probably somewhere around 4 or 5. So it's a pretty significant economy, okay? What is the EU? What is the EU?
European Union.
Okay, but what is it?
Oh, it's all the countries together, trading, free trade.
How many countries?
20?
Door number 2? Close. I think it's 28, because there's 27 left, so it must be 28, okay? So it's like 28 countries. So how many people are in the EU? How many people are in the US?
325 million.
Yeah, I don't know, call it 350 to be round, right? People are born every day.
400 million?
Try door number 2.
500 million.
500 million, right? How many people are in India?
No, it's like 2 billion or
Yeah,
billion.
like a billion. And how many are in China?
Like 3 billion.
Like 3 or something like that, right? So, I mean, these are still huge markets, but this is a huge market, and it's a bigger market than the US combined. So, but again, you haven't answered, what is it? So it's 28 countries that have done what?
United.
They've united, or they've come together and they're bound by an agreement that does what?
Allows free
Trade.
trade and travel and.
Okay, so there's
Immigration and trade.
there are 4 basic underpinnings of the EU, and I don't remember what they are, but it has to do with free movement of people and free movement of goods, right, and a common currency, okay, and I don't know what the 4th one is, you know, like whatever, they're all happy and, you know, whatever, so, but, so it's a union. It's kind of like, don't we have the same thing here? What do we call this thing here?
United States.
We call this Canada, and we call this the US, and we call this Mexico. And I know we're going to build a wall, and they're going to pay for it, but NAFTA. What's NAFTA stand for?
North American Free Trade Agreement.
Okay. And so what does NAFTA allow us to do?
Tax
Free trade between the 3 nations.
So there's kind of a similar, definitely movement of goods, right? And is there a common currency?
No.
Is there a commonality of like political structure and all
No.
that?
No,
Is there a commonality of languages?
no,
No.
No. Can people move around freely?
no.
No.
Okay.
So,
But in Europe, you can kind of do all that, right? Now, so this is all of Europe, right? What do you got here? It's an island, right? People, you're from an island, or I'm from an island. Are you
Yes,
from an
I am.
island? People from an island have their own way of, you know, seeing the world and seeing things. So I'll share this with you, and it'll give you a perspective on the English view of Europe. So BBC, what's a BBC?
British Broadcasting Corp.
Okay, right. So it's, you know, it's the very good. Okay. So do we all know what the BBC is? London time, you know, 6 p.m. whatever. So it's the British Broadcasting Corporation. First news broadcast in the BBC. End of the news broadcast. You get the weather. Now listen to the nuance here. The weatherman says there is so much fog over the channel that the continent is practically isolated. They're the island, but it's the continent that's isolated, okay? And so they have always looked at Europe from a sort of different perspective. They are full members of the EU, but do they share a common currency?
no.
No.
No. Do they allow for the free movement of people?
No. You still need a
I
visa
think
to
they
go in
do.
there.
No, you can come in with these the national identity cards, okay? So, like, we got to go in with a passport, but if you're like from Italy, you can just come in with your identity card, okay? But there still is not a total free movement of people. Is there free movement of goods?
Yes.
Yeah, so they do have that, right? So, and so what's happened? I think that's totally true. Like they're really hung up on like rabies and stuff, so I'm not really sure what kind of control. Seriously, what kind of control? There's no rabies on the island, but this is ultimately what the value that I think these trade agreements bring. And what are people in the UK concerned about? They're concerned about this, right? They're concerned about this, and then there's a whole other sort of underpinning back here underneath it, which is the whole sort of common political and social, you know, perspective, right? And so, what was the vote? what was the vote the other day?
52-48?
Something like that. Is that like a big majority?
Well,
Because, so like my youngest sister lives in the UK, my brother-in-law is a diplomat. So if you're one of the 48%, right, are you happy right now?
nope.
So yeah, there's a lot of, there's a lot of discontent there. And what's happened with the political structure in the UK in the last week? What's happened to?
Prime Minister resigned.
Okay, what happened? So who's taking his place?
They don't know
They
yet.
don't know, the guy they thought was going to decided.
What about the opposition? The Labour Party?
Well, they're not in power.
Okay, but is there any leadership there? That's all, a mess too, right? So what's happened is all of a sudden they're in a mess here. These people are pissed off. What's Europe saying?
They're thinking about Brexit.
Well, what are they saying? What's the European reaction to England voting on this?
Well, they didn't like it.
Okay, so you've heard things like, what did France say?
They're gonna
They're gonna pull out
exit.
too.
They're gonna exit.
No, they said, we don't want English to be the common language of the EU anymore. We want French to be the common language. I'm not kidding you, they really did say that, right? What did Germans say? Hey, forget all the finance, we want Frankfurt to be the financial capital of the world. We're only an hour away, right? And so everybody's sort of like now, sort of saying, plus, what did the head of the EU say the other day? They had their meeting of ministers and all that, and he looked at the British guy and said, why are you still here? Didn't you guys decide to leave? So now everybody's kind of posturing, saying, well, if you're going to leave, leave now. You got to leave now, and you're going to leave under our conditions. Yes, Ben?
Scotland wants to revoke
Yeah,
the
so now you
decree
got,
again.
hold on, I forgot Ireland here, right? So you got the United Kingdom of Great Britain and
Ireland.
And
Northern Ireland.
Northern Ireland. So you've got Great Britain, Scotland, right? Wales, right? And Northern Ireland, right? So you got Great Britain and Northern Ireland. These guys are saying what? No, we want to stay. Now, is that important? What are people in Europe saying about that? They're saying we don't want you. Why? Because then you got like regions here in Spain that are saying we want to be independent, but we want to be part of Europe. So they don't want to create the precedent, because then what's going to happen? These guys are going to say, oh no, we all want to be sort of our own little, sort of fiefdoms and all that. So what's happened is it's created a tremendous amount of political uncertainty and concern. As I see it, I could. By the way, curiously, I was going to say I got a summary from Goldman. Their sort of take on Brexit. Curiously, so the vote in Scotland was something like 62 to 38, right? 62% stay, 38% leave. Okay, this breakout was curiously the 50% was generally, or the 52% was generally the older population and the less educated. And Goldman pointed out that, curiously, that seems to mirror Donald Trump. Let's make America great again. Okay, so, but what happens in certain parts of the, Atlantic may also happen here as well. So what's happened with all of this is create a lot of economic uncertainty. My personal perspective, I don't think it really matters to us in America that much. I don't think it's that big a deal to us. We trade with the UK, we trade with Europe. We don't really have any sort of preferential agreement with the EU. We don't really have any kind of preferential agreement with either of those countries. We're invested, our companies are invested in both continental Europe and in the UK, but there isn't any sort of concentration in one or another that would make our companies more vulnerable in any way. We have financial institutions with activities in all those countries, but again, I don't see, from what I see, any bigger concern. So as it relates to us, I think that's a big to-do about nothing. And when I saw the reaction of the stock market Friday, I bought things. I didn't go crazy, but I started buying. And I think stock markets generally across the world have rebounded to higher levels than they were last Friday. So they dropped significantly on Friday, and over the next 3 or 4 days have kind of come back. So the investors have kind of said, yeah, maybe there is a big to-do about nothing. Okay, yes, Claudius?
From a trading perspective, if you consider economies of scale, isn't there going to be some issues with that?
You're saying as it relates to them.
Yes, to the EU.
Right, so what's happening, there's a couple of things that are important, and that's why I'm spending the time. Maybe you don't have the interest, but I think it's important. I've just spent 5 weeks overseas. It's important to look at the world not as an American, but as a citizen of the world, because that's how we understand what's going on in other places. Who are the big powers here? Who are the big powers in Europe?
Germany, France, Britain.
Okay, Germany, France. How many people in Germany? Yeah, 80, 90 million. How many people in France?
60.
I think, I don't know. I mean, they make a lot of noise, but I think there's only like 60 million of them. We just said Great Britain was like 60 to 80, right?
Right.
What's the next country in Europe? In
Spain.
population? No, Spain's only like 40 million. Italy.
Italy.
Italy's not like a political heavyweight under any scenario, or an economic. So the great design, you know, great food and all that, but you know, not really like a world. I'm sorry if there's any Italians here, I don't want to offend, but you know, not necessarily a big influence in the world, right? Spain's another one. I love Spain, but so what you've got 3 big parties here, right? Who starts the EU? How does the EU start? It was called the EEC, the European Economic Council or Community, and it was started by who? Which country started the European Union?
Belgium.
So it was the Benelux countries, Belgium, Luxembourg, and the Netherlands. And why was it important for them to get together?
They're all really small countries next to each other.
Because they're all really small countries with very similar values, with similar languages, with similar business cultures, and with an inability to compete. Because there's all these barriers there. So they said, hey, if we get together and we open up, now we're a bigger country, even though, and that sort of morphed or evolved into, you know, this whole thing with all these underlying principles. Now, I think what I hear is people in the UK are saying, hey, we want this. We just don't want this. Okay? And people in Europe are saying, hey, no, you got to have all of it. And what's happening is, again, this is personal perspective. These 2 countries want to rule the world. These people get along?
No.
They've had some wars between them, haven't they? Okay? So they sort of outwardly get along, but they're both looking to rule Europe. Okay? Maybe not in the way that they did, you know, 100 years ago, but they're definitely, and this country provides a tremendous balance to this push, right? So if you, for instance, go to Spain or Italy or Greece, some of the countries that have had some serious economic issues over the last few years, who are people pissed off at? Angela Merkel and Germany, because they're the ones that are pushing all the austerity down, making life difficult for people. Okay, and so for anybody here along the Mediterranean Ring, in particular, people are saying, hey, we need Great Britain in there because it's going to help ameliorate the dominance that these 2 countries have. Okay, and so I think all of this has created an incredible level of uncertainty. There's all the national pride. Well, they don't want to be here. Have them go away. We don't need them. We don't want them. You know, forget them. We're not going to trade with them. I think there's some precedents. There are some European states that are not part of the EU but are affiliated. Which ones are they? Do we know?
Norway, Sweden.
No, Swedes.
No, not part of it.
Norway,
Norway.
Switzerland.
Switzerland.
There's one other one. I forget which one. But so these are not. They're not in the currency on the move. But they do have free trade agreements. So I think people in the UK are saying, hey, leave us alone. Leave us alone. trade with us, and we'll trade with you. And that would be ideal, right? I think for them, they're saying you can't have it both ways, and I don't know where it's all gonna end up. I just don't think that for us in this country, it's that big an economic issue. Could it become an issue for the UK if they are not able to move their goods? I don't know. I don't know what the percentage of the economy in the UK is manufacturing, but I don't think it's very high. If you go into continental Europe, you don't, for instance, see a significant number of English automobiles, for example. They don't manufacture planes. I mean, it's really, the UK has become, there's 25 million people in Greater London, and it's a sort of financial services capital, center of the world. And so I don't know that it's as big an issue to them or concern as maybe some people fear.
Yeah, but my point is on the economy of scales front, when they're buying goods, they're gonna have to pay more now if they separate them.
Well,
Per unit of good, that is.
well, you know, I kind of look at, I'm not going to disagree with that, but I kind of look at it from a different perspective. The first sort of reaction of their currency was to decrease significantly. So I don't know in euro terms, but in US dollar terms, I think as recently as a year ago, the pound was trading like at $1.60 to the dollar. And it went down to like 130 the other day. And so they've got a weaker currency, which makes their exports much more attractive. And so what a lot of people have said is, hey, we kind of want to have that weaker pound because it's going to make our exports that much more attractive, and it's going to be an incentive to our economy. It's going to allow us to put more products into Europe. So if they don't want to have free movement of goods, that's fine. We're going to have a competitive product anyway, a competitive currency. So I don't know where it all winds up. I've always been a Euro skeptic. I don't think there's a reason why there's 28 or 30 countries and they speak gazillion. I mean, in Spain there's 4 official languages. Okay, in Switzerland there's 4 official languages. You know, you go to all these places and they haven't gotten along in centuries. What makes you think that they're going to have like a common social perspective and a common economic policy? I don't see it. You know, the German character is different than the Greek character, and it's different than the Italian character. And so I think there's been a push to something that just may not be sustainable, and this may be the beginning of it. But that it would make sense for them to have a free trade agreement, I think it makes all the sense in the world. Does it make sense for them to have a common currency where you then have to have common economic policies? The answer is no, because Greeks can't compete with German manufacturers. I mean, Spaniards, Italians, I mean, it's a different, you know, the further south you go, you know, I don't want to say people are lazier in the south, but, you know, we have the sun, we got the beach, right? We enjoy life. We're God-loving people, right? We're not God-fearing people like those that live in the northern cold climates, right? So, anyway, I mean, there's a whole sort of theory. Are you interested in any of this? You know, there's a, so if you look, the sort of northern part of Europe is much more, and you can kind of even look at it in religious terms, it's much more Protestant, right? Much more sort of God-fearing, industrious. And the south are, you know, predominantly Catholic countries, more, I want to say, God-loving, you know, God, you know, mercy of God, forgiveness. Let's go out and have a good time. Let's go drink wine, and let's take a 2-hour, 3-hour lunch, and let's not be as industrious, and somehow the Lord will provide. So anyway, so you've got these whole differences in the way people think and act and work. And so at the end of the day, I don't have any answers for you, but I hope that maybe you learned a little bit about what happens in Europe, what about things are going on. I just want to share one other thing. I'll share 2 other things. I was in Spain in particular. I was not in Spain. I was in a region of Spain called Catalonia, which is the northeast corner of Spain, where Barcelona is, all the way. So it's northeast corner of Spain and the southeast corner of France. So they've got their own language. Catalan is the oldest of the Romance languages. It predates Spanish and Italian and French and Portuguese. and Romanian, so they're written texts that are over 1,000 years old. And so, sort of interesting place. They've just had general elections in Spain. They had elections in December. They could not form a government, so there's not been a government in Spain since December. They had elections again last Sunday. The results were not dissimilar to what they had in December. And here's the problem, and why I bring all this up is because if we don't see what's happening in other parts of the world, we may not learn. So historically in Spain, there were two major parties. There was the Partido Popular, which was a more right-wing party. Some people say it was like, sort of like,
Republican.
well, no, so people believe, old line people tend to believe that this party his roots go back to Franco days and sort of, autocratic, sort of phalange, very right-wing, okay? If you were to look at it in American terms, this is a very liberal party, but in European terms, it's very conservative, okay? And then on the sort of left side of the spectrum, you had the PSOE, which is the Socialist Party, okay? Which again, now, American term socialism is not, so sort of call it more social democrat is probably a more palatable term, okay? And in most European countries, since World War II, you've had this kind of two-party sort of swing. The exception has been Italy, which has been ungovernable, and Italy has had 4 to 5 major parties over time. So what's happened in Spain is happening in a lot of different parts of Europe as well. Okay, and what's happened is this is now fragmented, and so you've got a party called Ciudadanos, and you've got PP, and the left is kind of splintered. So there was a communist party here that was kind of a fringe party, never was in power. So what's happened is the left is also fragmented, and so you've got the Socialist Party, and now you've got a party called Podemos. And Podemos is a blend of the old communists with a bunch of disenfranchised socialists. And then this comes out of financial crisis 2008, 2009. The government supports banks throwing people out of their houses, right? Because you gotta foreclose on mortgages, right? People go to the streets and say, hey, that's unfair. And out of all this comes this party. Now, why do I bring all this up? Because if, in most places you wind up with elections that are 52-48, 51-49, you find a way to govern. You now have something like, 18% of the vote, 16% of the vote, 15% of the vote, and like 30% of the vote. And then you've got all these other fringe parties. So now you don't have anybody that wants to get along. And so how do you govern with this fragmentation, right? Now, we're not there, but I'm kind of curious to see what happens in this country this month with the political parties, the conventions. And I don't see a big risk on the Democratic side, but I don't know what's going to happen in the Republican convention, because I just don't see the support for Trump that he really needs in order to mount a successful presidential campaign. And in fact, the other day I once again read how we've got this fertile ground to potentially have a third-party candidate. And we've had third-party candidates in this country. John Anderson, Ross Perot. Ross Perot cost Bush the election and basically gave it to Clinton. And so I don't know what happens, but I bring all this up because I think we're starting to get this sort of fragmentation in this country as well. I mean, we've got Republicans, right? But I don't know that all the Republicans want to vote for Trump, for example, right? But on the Democratic side, right, we've got a bunch of people that were, supported Hillary, but we had a tremendous number of people that were supporting Sanders, right? Feel the burn and all that, right? And so I'm not, I know we're in a real estate program, okay? But all this stuff ultimately, is going to direct economic policy. And that economic policy is going to have implications on government budgets, on taxation. Ultimately, it's going to flow down to interest rates and the movement of capital. And because we've said that real estate is a financial asset, and it's ultimately going to filter down into real estate as well. And so all of these things that are happening, you know, ultimately are going to impact what we do, or what we're going to do, or what we're able, you know, to do over time. So I don't have an answer. I don't know what's going to happen. I don't see this in this country that clear. I don't see Trump having the support that he needs to get out of this convention, and I don't know what's going to happen. I know nobody wants to sort of, you know, create an issue, but, and then, and I'm going to, you know, again, look, I tend to be, I don't want to identify with parties. I tend to be very conservative fiscally and politically and, you know, morally and socially and all that. But, you know, then I got back yesterday and I saw that the Attorney General met with Hillary's husband, with the former president to talk. I'm like, that happens in the third world. I mean, that doesn't happen in this country. Like, how does that happen? I mean, that's crazy. You know, so, again, I come from the outside. I haven't really been reading American press that much, and I see that, and I'm like, man, that's the kind of shit I saw in Spain, you know? You know, how does someone in that, first of all, how does he put himself in that position? How does he go, and then how does she actually acquiesce and meet with this guy? I mean, I happen to think that's a very big deal, so, you know, whatever. So I don't know if her emails are a big deal, but her husband meeting with the AG over the stuff is a big deal, so. Anyway, so, talked about, okay, real estate. Can I talk about real estate for a second? European real estate. I can shut up. You guys want to talk about development accounting?
Yeah.
Debits and credits? We'll get to that. We have plenty of time.
We're not getting out early?
We'll never get out early. Come on.
You thought that was a
I've
promise.
been teaching 8 years. I've never gotten out of class early. Come on.
Well, you made that promise earlier.
I know it. So it was a fib. It was an exaggeration. I just kind of exaggerated. Okay, so one of the things that I wanted to do while I was there was I wanted to meet with people that were, so I was on vacation, but I actually had an office, and I would go every morning to work every day, believe it or not. I mean, did I answer all your emails and all that? Did I post text? I didn't quite answer everything in everybody's email, especially when someone keeps asking me, how did I do on this? How did I do on this? So I think that's the only thing I didn't answer. But I made it a point to go meet with people in the real estate industry. So I had a meeting Monday or Tuesday with a developer, very large developer. I had a meeting the week before with another development group that I know, and then about 3 weeks ago I met with some guys that they're part of a sort of private equity hedge fund environment that are investing seriously in real estate. So a few things I'd like to bring back, just to contrast. So in this country, what are home ownership rates? Any idea? And we know, we've talked about this. Home ownership rates?
About 4 to 5%.
4 to 5%?
Wow.
Ownership, not interest rates.
Oh, sorry.
Yeah, so, you know, we've had, so I think in our lifetime, in my lifetime, somewhere between like 62 on the low side to maybe as high as like 65%. You work at Fannie Mae. What's the number? Is it something like that?
It's like 66.
2/3.
Did it go that high? I thought, but it came back down a little bit. Whatever, 2/3, a little bit less than 2/3. Okay. Is that high? Is that low? Is that the same thing in the rest of the world? What's it like? What's it like in Spain? Do we know? So in Spain, to my surprise, I knew it was high at 80% home ownership rates. Now, curiously, in this country, we've had all this sort of, you know, governmental incentives. So we've got the tax incentive, right, the deduction of interest rates and property taxes, which are a big plus, right, to home ownership. We've got the creation of entities like Fannie Mae to provide liquidity to the credit markets in order to facilitate, you know, low and accessible credit, right? We've had things like like the Community Lending Act, which is kind of pushed banks to provide credit or financing to certain, distressed areas and communities. But yet we've got a lower home ownership rate than, other parts of the world now. So Spain, 80%. Now, we've seen a tremendous amount of flight capital here in South Florida, and we've seen interest, residential prices go through the roof. In Barcelona, we've seen the same thing, but it's all sort of flight capital from Russia and some of the former republics and Middle East. Prices there are higher per square meter or per square foot than they are in South Florida, even though the economy is relatively distressed and you've got unemployment of about 20%. And so, residential prices through the roof. How people do it, how people live, I don't know. I haven't figured that out, okay? But you've got that. Industrial product. So in this country, what's the sort of mix between owner-occupied and rental industrial real estate? Do we know, roughly?
30%.
30% what?
Ownership versus.
So 70%.
No, 30% owned, 70% leased.
So again, my sort of, I don't know that there's an exact number, probably closer to 40% ownership, 60% lease. So we've got a much more sort of vibrant institutional perspective. And there's a sort of capital markets perspective that says the highest and best use for my capital is not to own my real estate, but rather let somebody else own it, earn his fair or her fair return, and I'm going to invest in my technology, my R&D, my working capital, whatever else I need to do to run my business. In Europe, you've kind of got, mainly through all of Europe, not only in Spain, you've got kind of the switch. So you've got 60, 70% ownership by companies, and only about 20 to 30% is for leased product. And so you're now starting to see in Spain, in the UK, in France and Germany, you're starting to see very similar laws to REITs. In Spain, they're called SOCIMI. So you've got, the elimination of the double taxation in exchange for the distribution of passive income, but you still don't have, the sort of capital markets that you've seen here. Okay, and so you don't have the institutional ownership. Credit markets, significantly more restricted than here. Loan-to-value rates, and I'm giving you across Europe now. One of the developers I met with, from Poland all the way to Spain, they work and have developed. The other smaller group has got stuff in the Czech Republic and in Switzerland as well. So LTVs, 50% to 60% maximum. You see a fair amount of recourse debt. Now, highly stabilized, good sponsorship. You may see some non-recourse debt, but there's a fair amount of recourse debt. Construction financing, pretty much all recourse. Okay, cap rates for the most part, because of what we talked about, significantly lower than we see in this country for prime assets. Okay. Development rights, municipal roadblocks, citizen opposition, significantly higher in Europe than it is here. You've got from Greens to very sort of far leftist type parties. You see a tremendous amount of opposition to property development. You've got a lot more sort of restrictions related to people preserving historical assets or presumed historical assets and things like that. So higher rates, lower debt availability, higher cost of debt, okay, bigger roadblocks to development, less institutional ownership. So that's kind of, so we live in a great place, all right? We live in a great country, and that's that. Any thoughts, questions, opinions? Want to get to accounting? You guys want to go over the case study? Yes. Okay.
Quick question. So did you see more, like, because obviously those places are a lot smaller than the United States and everything like that in terms of, from Spain to Italy and all that. Was it more like multifamily ownership, or was it actually like single family?
No, so it's, so, you don't, in Europe, you don't tend to see, you know, very extensive or expansive cities. There's some exceptions. London is a huge city. It has, you know, pretty significant height restrictions throughout most of the city. And you've actually got a pretty well laid out transportation grid that kind of gets people around. So London kind of gets away with that. Paris is also a huge city, although it has a lot more density, okay? But most cities, you know, when you go to the Romes and you go to the Madrids, you go to Barcelona, Barcelona is 4.5 million people. It's basically built, so again, I don't draw very well, okay? So there's the Mediterranean, there's kind of a profile. There's a mountain here, Tibidabo, right? Okay, and so there's no development like, let's say, like the top 2 miles of the city, right? And the city's kind of built down. But there's probably no more than about 4 miles from where you have development down to the Mediterranean. And then sort of north-south, you probably don't have more than 5 to 7 miles, and you got 4.5 million people in there. So, you know, very dense, and that's not atypical. And so to answer your question, you don't tend to see suburbs. Why? There's no services, right? So, I mean, I lived there a long time ago, and you would never live in outside the city. You could now. You're starting to see some of the light rail and all that connect, but the problem is where do you shop? You know, so again, I'm giving you Spain, which is similar to Italy, which is similar to Greece, which is similar to Portugal, you know, sort of southern Europe. But you've got similar rules in places like Germany. So in Spain, it's common that stores close. I don't know if you do a siesta. I mean, you might fall asleep watching the news on the couch, okay? But stores will close in the northern, you know, from 2 to 4, maybe 2 to 5, and in the south, in the summer, I mean, they'll close like from 12 to like 6 or 7 at night. And just culturally, like, when people say, oh, we'll do this in the afternoon, like to me, the afternoon ends like around 5 o'clock, maybe 6 o'clock, right? In Spain, the afternoon ends like at 9, because we have dinner at 10. So, you know, it's just, and so why am I telling you all this stuff? And then on Saturdays, stores tend to close middle of the day. But you get places like Germany where stores can't open at all beyond a certain hour on Saturday and cannot be open on Sundays. They cannot be open on Sundays. And so you need to live near places where you can get stuff. There's no Walmarts, you know, that are open 24/7. Okay? Most people in these major cities buy their produce at markets. So you go to a market. I mean, like the farmers markets you see popping up now, where, you know, there's like a place that people bring that's where people buy. And those tend to close like, you know, they're not open weekends, they tend to close early. And so you need to be where all the action is. Okay, so it's all sort of high-rise, mid-rise or high-rise, but it's all sort of condominium-type ownership, to your point. So you don't see, now, Germany's kind of an example. There's a significant amount of rental. There's a huge rental market in Germany in the major cities. Berlin, you know, et cetera. The major cities in Germany tend to have a lot of multifamily for rent product with a lot of institutional ownership. But in most of the rest of Europe, you know, it's mid to high rise, but sort, you know, ownership. And then you've got nuances. The UK has a lot of leasehold where people build on land. So you're paying a land lease to Queen Elizabeth or whoever, you know, some knight somewhere, and then, you know, you own the leasehold on top of that. So
Yeah, I was just curious, just because, you know, I figured it had to be very dense, and then when you said that their ownership rate there is, you know, pretty high.
yeah, but you also have cultural difference. I mean, what's very common and typical is, you know, you get married and your parents give you, you know, a place to live, and you say, well, how does that happen? Well, you know, I'll give you the people I stay with, they've got 3 kids, right? So they've got 4 apartments. The first one they bought when they first got married, they leased that one, right? They bought another one, they leased that one. They live in one now, and then they inherited one from a dad. So when their kids get married, what's gonna happen? One's gonna get this one, that one's gonna get that one, and the other one's gonna get the other one. And they'll sort of repeat that cycle, you know, so, anyway. All right, let's go through the case. Let's go through the case. You guys wanna do the case? Yeah, let's do the case. Take a little, just a second break. Yes, take it.
Can I open my computer up to review what I wrote while we speak about it?
Negative. Negative. You know what I would recommend is why don't you
No,
print
no.
it like I do? Why don't you print it like I do? Like I could open up the computer, right, and sit behind it and do the same thing, right? Why don't you print it and bring it? Or listen, and you remember what you wrote, don't you? You don't? You mean you didn't really focus on it?
I did, but you know, go a minute.
Those are like, you sound like, you know who Jethro Bodine was? Anybody know who Jethro Bodine was? Beverly Hillbillies? So, Beverly Hillbillies, anybody remember that? I mean, I'm really like dating myself. You don't know who the Beverly Hillbillies?
Yeah.
Okay, so.
The truck oil became rich.
Okay, there you go. So Jethro Bodine, you know, he got learned at his school, and they learned him like addition and subtraction and multiplication and gazintesis. You know what gazintesis are? 2 goes into 4, 2. 2 goes into 6, 3. 2 goes into 8, 4. It was like just reminded you when you say goes in and goes out. It's like he did gazintesis. Okay, so anyway, listen. So my basic premise on a case like this. So the easiest thing to do every time I teach this class, I pull out new supplemental reports. And it's a pain for me to do. It's a lot easier for me to have kept, you know, the same one from 8 years ago, right? But for me, it's important. For me, it's important that 1, I stay up to date, but 2, that the students are looking at information that's timely and relevant. Okay, and so those of you who have done who did the due diligence class and did a closing statement, it's not as dynamic. So closings are not as dynamic. Concepts are not as dynamic. But financial information, lease rates, you know, debt schedules, things like that, you know, are much more sort of fleeting. And so for me, it's important that the students also get a chance to look at updated or more recent information. And so there's certain asset classes that I try to focus on. I always use Simon, and the reason I always use Simon in these cases is because Simon puts out an incredible supplemental report. You know, you saw how thick it was, and you get an incredible level of insight. So I use supplemental 1 because I think it helps the students become more familiar with financial information. And as I said in the first class, the more you touch financial information, the more you touch the data, okay? The more that you keep texting, the more upset I'm going to get. I can't do it. It's bigger than me. Because you see, your professor loses his train of thought, okay? As you now know, there's a 3rd class we go through this. So the more that we touch financial information, the more we become accustomed to it, the better a feel we get for it, okay? And then it'll become second nature. You know, first time you ride a bicycle, you fall down, or your dad or your mom runs behind you holding you, right? And so then the second time, you know, they get training wheels, and then eventually training wheels come off, and you sort of, you know, and then you start doing wheelies and, you know, jumping ramps and all that kind of stuff, okay? And that's the same thing with financial information and financial reports. I also like to use the supplementals, I think, as I said in the introduction, because it provides an incredible level of insight into operating metrics for different asset classes. And so, you know, where I don't know, some of the questions, and we'll go through them in detail, some of the questions talk about, you know, leasing spread, and it sort of helps you understand how people are managing their business and what they think is important. Or we take a look at percentage of operating expenses. What should operating expenses be in multifamily? What should they be in industrial, okay? Where's the rental market? why do big users pay less than, you know, inline users in retail and things like that, okay? You know, there's reasons for all of that. From my perspective, I'm going to repeat what I said in first class, which is methodology is key. And so if I've got a critical comment to make, a lot of what I read on the plane the other day was sort of like, okay, let me just get the quickest answer that I can get. I happen to get a very well thought out case from one of the students. I don't necessarily agree with all the conclusions, but I like the approach, you know, that the student took, which was to try to go beyond what the answer was, right? Now, some of the answers were very simple. You know, the FFO, you know, for the most recent quarter, the price earnings was X, all right? But there were some questions that were much more open-ended that really would give, I think, rise to students developing the critical thinking that that you need to have to be successful professionals in this industry, right? So if I were to, for example, ask or have a student address market and tenant and geographic concentration, for example, it really does lend one to really address some of the critical components of underwriting transactions, right? So, you know, you can look at credit, right? But sort of on a more macro level, right? If 60% of my tenant base is in a particular industry group, does that present a problem? And if it does, why does it? Or how can I mitigate it? Or how can I, you know, avert it? And so a lot of the open-ended questions in the case were designed to get you a little bit, you know, more beyond, right? There were some questions, for instance, regarding debt. I kind of had you take a look at coverage ratios, and you know, one of the questions was very straightforward, which was, okay, is this good or bad, and why? But then I said, okay, well, give me a coverage ratio, and I said, now take a look at debt maturities. And can you look at a ratio in just one light, or do you need to contrast it with something else, right? And again, like as an example there, I didn't get a lot of the sort of thinking of, I got the same answer. Oh yeah, the ratio's really good. Yeah, but you got $1 billion worth of maturities in a year. What do you do then? So your historical cash flow works, but now you've got something you got to consider. Now, maybe it's not fatal, maybe it's not the end of the world, but now you've got a different consideration. And those are kind of questions that were sort of steering you to understanding that ratio analysis or financial analysis has a lot of different sort of, you know, sort of perspectives to it, right? And you've got to take a look at things, you know, really from a 360-degree view. It's not just as clear-cut as, hey, and I'll use a different example, hey, working capital is good. Well, if a company that you're looking at has really good working capital, but 90% of their current assets is inventories, maybe you need to take a look at the quick ratio and see if inventory were an issue, what would their current, you know, what would their working capital look like, all right, or what would their current ratio look like, right? So, the module gave you a series of tools that you could use in financial analysis, but we need to go a little bit beyond that, okay? In a lot of cases, there were multiple questions to, and so I got partial answers, right? So I got like one answer, but there were 2 or 3 follow-on questions that weren't addressed. So yeah, you know, maybe it was just I graded it a little bit more, I'd say critically than some of the other ones that I've done. Am I overly concerned? No. Did I get like horrible submissions? No. But would I, as an instructor, have liked more in-depth analysis, a deeper look, a deeper dive? From most of the students, I would have liked to have seen a deeper dive. Okay. That's, you know, you asked earlier in the class. You asked.
Can I ask a question?
Of course. I just pointed you.
When do we get to find out how we did on these case studies? Because, like you said, some people put in more effort than others. You know, some people want to know how they do on individual case studies and see how they're, you know,
Okay.
what they need to focus
Right.
on, so.
I will, because I was traveling, it was very difficult
Yeah.
for me to do an individual for 26 students,
Yeah.
caught of all their views. I'll get you one as soon as I have an opportunity this week.
Not like this is, you know, but just, you know, so we can kind of get an idea of what you're looking for, because I think last time after the HOV, you said some of these answers were way too long, and things need to be more concise, right? Was it on the email, or was it in class that you said that, you know, you were looking for a little bit more compactness? But now you're saying.
I don't think I said
Yeah.
that after the HOV, and in fact, I know I taped the
It's
sessions
either in an
before I did
email,
it.
or maybe when you were
Okay.
going over it.
Well, but to answer your question, I think we're going over them, and you know what you've answered, and we're gonna go into it in detail here. And so if you wanna know what I'm looking for, I'm gonna tell you right now, okay?
But what about the grades? Are we gonna get the graded papers?
I just said
back?
no, you're not gonna get the graded paper back, you'll get the grade,
Oh,
okay? And if you've got specific questions, I'm happy to do that. I can't do that for 26 students. When I had 6 or 7 in classes, I would always give them back. I would print them and grade hard copies. It's very difficult to grade 26 papers in 3 days and bring them back to class. The other thing I found is if I give them back, then I don't get the attention. It's very similar to, let's have the dialogue now and let's go through the questions, okay? So I'm going through this. The first 2 or 3 were relatively simple questions to go through. You know, what were common themes, right? I think all of these supplementals have financial summaries, right? Those financial summaries include balance sheets, they include income statements, they include very detailed calculations on FFO. What is FFO?
Funds for operation,
What is it meant to be indicative of?
net operating income.
What's the revenue divided by how many shares?
No, not, so you're going on like, so it's not revenues, it's, to be more precise, so NOI is a measure of what?
Of an investment.
Operations.
It's cash flow. It's cash flow, okay? Because NOI is basically what? Net income adding back what? Adding back what?
Operations.
Depreciation. Okay? Roughly, okay? I'm not saying it's that, okay? But, or looked at another way, it's going to be your revenues less your expenses, but in accounting terms, and we're in an accounting class, NOI does not have within it expenses, right? It does not have depreciation, okay? So we're looking for cash flow from, and so REITs are saying FFO is basically what? Give me a more direct answer to FFO. What is FFO? Net income plus what? Or net income in a REIT which has no tax. Net income plus what? What do we add back? Depreciation plus what else? We should all sort of, when we did this the first class, it's an issue of becoming familiar with terminology that we see in the industry, so that when people are talking to us, we understand, right? And in particular, one of the answers I want to get to, there was sort of interesting case, plus or minus gains on sales. Gains or sales, right, of assets, okay? And so, to the extent that you've got extraordinary income that's not recurring, right, it's going to be excluded. So what we're looking for here is, what does it appear that our operations provide as cash flow on a going forward basis, okay? And so when REITs talk about, so REITs are public vehicles in a non-REIT environment, in a public, in a private company environment, in an institutional investment environment, we're going to talk about NOI. In a public company environment, we're going to talk about FFO. Now what we're trying to get to is what's recurring? What are my operations producing as cash flow that I can count on, or that I can service debt with? Okay? So, so they go into extensive FFO calculations. They also go into AFFO, and I won't spend a lot of time on that, but that's an adjustment to FFO which addresses the straight lining of rents. We talked about straight lining of rents 2 weeks ago, so plus or minus the effect of straight line rents, right? And non-recurring CapEx items, okay? Some do ratio analysis. They have extensive debt summaries, so they talk about their debt structure. They talk about their capital structure, they talk about their debt structure, maturities, interest rates, the nature of the type of debt that they have, okay? And in a lot of cases, they have leasing statistics or other operating metrics. Now, what tends to happen is, so like I, for instance, pulled out UDR. UDR is a multifamily REIT, okay? What happens is REITs that are in similar asset classes tend to report very similar to their peers. That way, readers can compare them. So if you look at an industrial REIT, the metrics that they're going to show, the leasing statistics, are going to be similar to all the other industrial REITs. So East Group and Prologis and First Industrial are going to report similar, okay? Other retail REITs, Tubman is going to report similar to Simon, etc. UDR is going to report similar to Mid-America Apartments or Avalon Bay or Equity Residential, okay? So REITs tend to mirror one another, okay, in their reporting. Some tend to be very extensive, some are not. I don't think you like the multifamily. I find the multifamily, they get very extensive, and I've done 6 or 7 of these REITs in different classes over time. They go on all this like same store and average per apartment, and it gets very confusing, and at the end, I don't get a lot of information out of it, where you go into assignment and you start seeing, hey, wow, look at this lease expiration schedule. I mean, you can really start looking out into the future. Look at the leasing spread that I have. You start getting out, you start saying, hey, I think this company can do well into the future. Plus, it's also giving us insight, okay? To the extent that some of these REITs are active in development, there is also development activity in summaries that they present, okay? Those are kind of the common themes that I had. Principal asset classes. KRG.
Commercial, real estate.
Offices.
Yeah, so, I mean, it's a simple asset class, office, okay? I got, and again, look, bless you. I didn't, these aren't marked wrong, but, you know, KRG is an exclusive developer of premium, what asset class? Office. UDR, multifamily, Simon, retail. Okay, so yes, they have malls, they have outlets, they got a gazillion different breakdowns, but the general asset class that they're in, the asset class is retail, okay? Diana, oh, you're struggling here, okay, sorry. Okay, for the most recent quarter, okay, so I did get a couple of questions on, there was no trick here, the most recent, it was not a trick question. The most recent quarter was the one you were looking at, okay, so I was not looking for
2016.
2016, okay, I was not looking for that.
Yeah, I was actually, I guess, even though it wasn't even bad,
Okay.
because it helped me to do all the research to like, in other pages. So at least I did the one for December, but I also go for the one for March because
Yeah, and I saw it, and I thought that was great. That was the case where you went. Now, curiously, where I was going to go, and you're going to lead me to the point that I was going to say, is almost all of the questions that I asked, the information that I was looking for was in the case. Yet I got a bunch of people, I mean, this is the Google problem, right? So, if I ask for a price-earnings ratio, I don't want Reuters price-earnings ratio. I want your ratio, okay? Which you calculate, which you know to be right, okay? So if you've got a report in front of you, and I'm just kind of looking at you but if I've got a report that's got the information, I don't need you to go to Yahoo or Google or CBS Market Watch to get the answer. You've got it. And in a lot of cases, I got people, well, you know, I got this from Bloomberg or whatever. You've got it in front of you. The company's giving it to you, right? I'll give you another one. You know, I asked, what's the debt to market capitalization ratio, right? Well, you can calculate it. You know, the company said this. Curiously, the company reported different numbers than what I calculated. And very few of you actually took the time to say, hey, let me take a look at this. Let me try to understand this a little bit better, right? And in some cases, I got sort of third-party reports. Well, you know, according to, you know, whoever, this is what the ratio is. Well, the company gave you one, plus you had the ability to calculate it yourself. And why I think this is important is people will always tell you what they want to hear, or what they want you to hear, I should say. All right? When people give you financial information, if you've got the tools and you know how to calculate things, calculate it yourself. Don't go to the third party. Calculate it yourself. I'm going to get to why in a second. Okay? Fully diluted, net income. It was there. Page 6, page 11, and page 12, respectively. So 27 cents, $1.27, and 61 cents. For the most part, you guys were all on these things. So let's go to, just so that in a REIT, net income does not have tax, okay? So, because there is no tax in a REIT structure. So if we add back depreciation, we get FFO, okay? Now, what's going to happen is, in most companies, people are ultimately going to talk to you about any sort of derivation of this. They're going to say, hey, we want to take a look at, like, for instance, earnings per share, right? A lot of these REITs are also then going to add information and say, hey, you really should take a look at what is FFO per share, okay? Now, I didn't ask for FFO per share. I didn't ask for FFO per share. I asked for earnings per share. But just so that you're aware that a lot of REITs, right, are going to say, hey, on a per share basis, this is the cash flow that we're providing. Now, why are they doing that? They're trying to steer you to a better looking number, okay? They're trying to steer you to something that looks good. But what's important too is non-real estate companies kind of steer you to the same thing. And I think in one of the earlier sessions I talked about this. Almost every time that you look at an earnings release from a company today, I think the number I saw the other day, almost 80% of earning releases have some sort of adjusted earnings per share. They're saying, hey, our net income was this, but you really need to add back all these non-recurring items. This is really the number you need to be looking at, okay? So, whether it's true or not, doesn't matter. But when you evaluate a company, okay, you should take a look at what they tell you, what the results are. You can then take a look at what their perception is of, whether things are recurring or not. I think the comment I made is that if every quarter you have unusual and non-recurring items, they're probably not that unusual and they're probably recurring, okay? So you just take a look at that, okay? So we had earnings per share, all right? And then the next one was, so what's the PE ratio, right, on a trailing 12-month basis? Now, why is it important? So what's trailing 12 months? What's trailing 12 months?
Previous 12 months.
So if we're looking at it, so we look for the most part at calendar year ends, or most companies are calendar year ends, but if we're looking at March 31 numbers, what would be the trailing 12-month period?
March 31st, March 31st.
April 1st of the previous year to March 31st. Now, I throw this in for your personal knowledge. So from an accounting perspective, when we look at PE ratios, we tend to look at this because this is a known number. In financial circles, when people are trying to analyze companies, people are going to look at some sort of forward estimate, okay? So instead of using the trailing 12 months, they're going to look at what the company's estimating or what analysts are estimating as what the future earnings are going to be, okay? So when we take a look at, for example, if you were to take a look at the Wall Street Journal, when they've got, bless you, when they've got the Dow Jones Industrial and they've got the S&P and the NASDAQ composite, right, the NASDAQ 100 composite data that they show every day, they show you a historic PE ratio. Why is a PE ratio important? Okay, so a PE ratio in a way is like a cap rate. It's a relative indication of value. And so if you want to take a look at what a company may be worth, you're going to say, hey, it's trading at 15. The question is what are peers trading at? Are they trading at 20? Are they trading at 10? Is this cheap or is this expensive? it's no different than saying, hey, I can buy that building at a 5 cap. What are similar buildings trading at? At 6 or 7, right? So is 6 expensive or not, or is it a midpoint? So it is a relative measure of value, and it also gives you a historical view, a historical framework. So where I'm going with this is so Wall Street Journal every day is going to give you, I don't know what the Dow Jones trades at, but this one's like at 22 or 23, something like that. But this is on trailing 12 months. They also give you a forward view. So a forward view with expected. And there you're going to see 16 to 17 times, okay? So then you can draw your conclusion and figure out whether this is attainable or not, and whether this is expensive or not, okay? But this at least gives you the historical framework where you can say, okay, 10 years ago, where was the S&P trading? 20 years ago, where was it trading? A year ago, where was it trading? Okay? And so but you can't just look at past, you also need to look at future, okay? So I didn't ask you to look at that, but I wanted to give you that sort of explanation, okay? Now, yes?
Is your preference what would be low?
Well, if it's lower, what basically means, so let me back up and say, you want it to be in line with the peer group, okay? So for example, let's take a look at pharmaceutical companies. I'm going to give you approximate numbers, okay? If you were to take a look at pharmaceutical companies, okay, pharmaceutical companies are probably trading at any given point in time at 25 to 30 times earnings. And what that means is for every dollar that the company earns, it's going to take 25 to 30 years to recover that dollar. Now, this isn't a dividend, this is an earnings number. Just like cap rate, NOI doesn't mean you're distributing that NOI, okay? All right, so, but what this is basically telling you is, so this is a relatively expensive, right? You have to wait 25 years for every dollar that you're buying, okay? Or you're going to wait 25 to get your price back, you got to wait 25 years. Now, there's certain industries that trade at much lower multiples. So for example, today I'm going to tell you oil services firms, okay? So, Transocean and Seadrill and companies like that are probably trading like 8 to 10 times. So from a relative perspective, you may say, hey, these firms are trading cheaper than these firms because I only have to wait 8 years to get the dollar back. Now, there's no sort of math to all of this, but just intuitively, typically companies that have a higher PE ratio tend to have higher growth associated with it. And companies that tend to have lower PE ratios tend to have less growth associated with it. Okay? Now, looked at in real estate terms, you could say these might be value plus or opportunity type plays where a significantly larger component of your return is going to come from capital appreciation, right? Not from dividends. And companies that are already, slower growth tend to be very mature product cycle companies. They tend to pay dividends, okay? And so you're likely going to get a higher return of your overall return, your holding period return from dividends, and less from capital appreciation. Now, to your question, if there is a company in this industry group that's trading at 35 times, it's very expensive. If a company in this industry group is trading at 10 times earnings, it's very cheap. Okay? And so this might be a very quick way, relatively, just like comparing cap rates, of saying, hey, how do I compare to everybody else? Is this cheap or is this expensive? Might there be an opportunity here or might there not be? Hey, this trading at a higher cap rate than all the other office buildings. Maybe it's a good opportunity or maybe there's something wrong with it. Okay? Does that make sense? Make sense? So, by the way, so one thing couple of you, Claudius, you can clap your hands, sent me spreadsheets with their calculations. A lot of you didn't. So I don't know where numbers came from. And then the other one, which is just, again, from a readership perspective, so my suggested solution, I've got a spreadsheet and I've got a Word document. And in the spreadsheet, the Word document, I embed my spreadsheet with some calculations, right? So what you needed to do to get the right answer was you needed to get the stock price as of the quarter end, right? Not as of today, as of the quarter end, and divided by the earnings per share, okay? And that will give you the price earnings ratio, okay, price earnings ratio. So 26 for Kilroy, 33 for Simon, and